One earnings miss, one brutal trading day, and suddenly, Wall Street began asking a much larger question. Is artificial intelligence starting to break the old software business model? On July 14, 2026, IBM shares plunged 25% to $217.07, their largest one-day fall since 1968. This was not just a normal earnings disappointment. IBM warned that customers were redirecting budgets away from its products and toward the hardware needed to build artificial intelligence. This is the Global Ledger, a premium investment, business and financial intelligence channel. If you want to understand more about AI and technology disruptions and their impact on global markets, please subscribe. And we always welcome topic suggestions from you. If there is a topic you want to know more, let us know in the comments. The question for IBM is no longer whether AI is powerful. The question is who gets paid and who gets squeezed as corporations rush to build it. IBM reported preliminary quarterly revenue of $17.2 billion, below Wall Street's expectation of $17.9 billion. Diluted earnings fell 2% to $2.27 a share. The key weakness came from IBM's mainframe business and the transaction processing software attached to it. The infrastructure division, including mainframes, suffered a 7% sales decline. For decades, these systems were among the quiet foundations of corporate technology, unglamorous, expensive, deeply embedded, and difficult to replace. But Wall Street does not forgive uncertainty. When a legacy profit engine begins to sputter, investors do not wait for the full diagnosis. Corporations are rushing to secure the physical machinery of AI before prices rise further or capacity disappears. They are shifting spending toward supply-constrained AI infrastructure, servers, storage, and memory. This is confirmed by IBM's CEO, Arvind Krishna. He said customers had rushed to secure supply-constrained AI infrastructure before prices increased. IBM also failed to close several large deals on time and said cybersecurity worries distracted clients. This is how disruption first appears in enterprise technology, not as collapse, but as hesitation. Every technology budget is finite. If more money goes into AI infrastructure, less may be available for legacy software, services and upgrades. The shock did not stop at IBM. Microsoft fell 2%. Workday dropped 6.3%. Salesforce lost 3.2%. Autodesk declined 2.4%. And SAP's US-listed shares slid 3.4%. IT services companies including Accenture, Cognizant and Infosys also fell. The iShares software ETF was already down more than 12% in 2026, while the Philadelphia Semiconductor Index had gained more than 78%. That divergence tells the story. Investors are rewarding the companies selling the hardware AI needs and punishing companies whose software budgets may be squeezed to pay for it. IBM insists AI is an opportunity, not a threat. Its Red Hat unit grew 11%. Showing strength in the parts of IBM tied to cloud infrastructure and enterprise AI. The bull case is that IBM can use AI to modernize enterprise technology, defend its customer base, and become part of the next infrastructure layer. The bear case is more brutal. AI tools may automate coding, modernize legacy systems, and reduce demand for traditional software and IT services. Software companies once sold productivity. Now AI threatens to produce some of that productivity directly. Cybersecurity is also changing. AI can help detect threats, write patches, and automate parts of security operations. The rise of powerful AI models such as Claude Mythos raises a deeper question. What happens when the tools begin to replace the software workflows they once supported? AI does not merely create new spending, it may consume the budgets that once supported traditional enterprise software. For years, recurring software revenue was treated as durable. IBM's crash reminded investors that even durable revenue can be repriced when technology priorities shift. To be clear, IBM's miss alone does not prove the entire software sector is collapsing. One analyst called that conclusion a bit of a stretch. But in markets, warning shots matter. They force investors to ask questions before the earnings damage becomes obvious. AI is creating enormous winners in chips and infrastructure, while forcing IBM and the broader software industry to prove they will not become casualties. The lesson is this: the first major casualty of a new technology is often not the weakest company. It is the company investors thought was safe. The IBM crash may be remembered not only as an earnings miss, but as the moment investors began pricing a more dangerous AI disruption. If you have other comments, please let us know. Until next time, follow the intelligence.